Welcome to Matters Financial and Geopolitical from a Frontier. Trust you had a wonderful weekend. Macro thoughts. I've just announced to the King of Spain that we have an agreement on Gibraltar, said the Spanish Prime Minister Pedro Sanchez in a televised address. Spain will vote in favour of Brexit. The pound rose after European leaders endorsed Britain's Brexit divorce terms as high as 128.15, so not a strong recovery. And I think that's because the challenge for Theresa May is in preventing an implosion of the parliamentary party and holding on to the DUP. And that we will discover a little further down the line. Brent crude is down to below $60 a barrel from a peak of $85 in early October. It's been a dramatic slide. The FT is leading with how strongmen play their cards will determine the next move for oil. The next big move in oil prices lies in the hands of three unpredictable strongmen: President Trump, Russian President Vladimir Putin, and Saudi Arabia's Crown Prince and day-to-day ruler Mohammed bin Salman. Having unsubtly indicated he is prepared to overlook the likely involvement of MBS in sanctioning the murder of Khashoggi, Mr. Trump should hold the whip hand over Riyadh at this stage, concludes the FT. And I wrote a piece on the 12th of November when I said crude oil, a Crown Prince plays his get-out-of-jail card. And essentially I was saying that the slump in oil had been engineered by the Crown Prince. And I'm just not sure what kind of profit he's made off the back of it and whether he was actually the major seller on the way down. Call it the MBS discount. Since Jamal Khashoggi's brutal murder by Saudi Arabian agents in early October, equity and bond prices in Riyadh have slumped. The sell-off is tangible. Foreign investor exposure to shares on the Saudi Tadawul exchange fell almost a quarter in October from the previous month. The Tadawul all-share index is 5% below its October high. Meantime, the cost of insuring Saudi senior debt for 5 years has jumped over 20 basis points since October 5, while that regional rival Qatar has barely budged. And the spread of a Saudi Eurobond maturing in 2028 over US Treasuries has spiked up over 35 basis points to 144 basis points, near 10-year highs. Refinitiv data shows. So you can see that there has been a financial blowback on all of this, but obviously the G20 meeting becomes quite interesting. Came across an old article by Malcolm Gladwell. One day in 1996, a Wall Street trader named Nassim Nicholas Taleb went to see Victor Niederhofer. You must read it in full, it's fantastic. Look at this snippet about George Soros. Seemed to be successful for a reason too. He used to say that he followed something called the theory of reflexivity. But then, later Soros wrote that in most situations his theory is so feeble that it can be safely ignored. An old trading partner of Taleb's, a man named Jean-Manuel Rozan, once spent an entire afternoon arguing about the stock market with Soros. Soros was vehemently bearish, and he had an elaborate theory to explain why, which turned out to be entirely wrong. The stock market boomed. 2 years later, Rozan ran into Soros at a tennis tournament. "Do you remember our conversation?" Rozan asked. "I recall it very well," Soros replied. "I changed my mind and made an absolute fortune." He changed his mind. The truest thing about Soros seemed to be what his son Robert once said. "My father will sit down and give you theories to explain why he does this or that, but I remember seeing it as a kid and thinking, Jesus Christ, at least half of this is bullshit. I mean, you know the reason he changes his position on the market or whatever is because his back starts killing him. It has nothing to do with reason. He literally goes into a spasm. And this is his early warning sign. Everything that can be tested must be tested, and so when Taleb started his own hedge fund a few years later, he called it Empirica. Nassim Taleb and his team at Empirica are quants, but they reject the quant orthodoxy because they don't believe that things like the stock market behave in the way that physical phenomena like mortality statistics do. Physical events, whether death rates or poker games, are the predictable function of a limited and stable set of factors and tend to follow what statisticians call a normal distribution, a bell curve. But do the ups and downs of the market follow a bell curve? The economist Eugene Fama once studied stock prices and pointed out that if they followed a normal distribution, you'd expect a really big jump. What he specified as a movement 5 standard deviations from the mean once every 7,000 years. In fact, jumps of that magnitude happen in the stock market every 3 or 4 years because investors don't behave with any kind of statistical orderliness. They change their mind, they do stupid things, they copy each other, they panic. Fama concluded that if you charted the ups and downs of the stock market, the graph would have a fat tail, meaning that at the upper and lower ends of the distribution, there would be many more outlying events than statisticians used to modeling the physical world would have imagined. In the summer of '97, Taleb predicted that the hedge funds, like long-term capital management, were headed for trouble because they did not understand the notion of fat tails. Just a year later, LTCM sold an extraordinary number of options because its computer models told it that the markets ought to be calming down. And what happened? The Russian government defaulted on its bonds, the markets went crazy, and in a matter of weeks, LTCM was finished. Spitznagel, Taleb's head trader, says that he recently heard one of the former top executives of LTCM give a lecture in which he defended the gamble that the fund had made. What he said was, look, when I drive home every night in the fall, I see all these leaves scattered around the base of the trees. In other words, the Russians, by defaulting on their bonds, did something they were not supposed to do, once in a lifetime rule-breaking event. But this to Taleb is just the point. In the markets, unlike in the physical universe, the rules of the game can be changed. Central banks can decide to default on government-backed securities. And then describing this, Empirica has done nothing but lose money since last April. We cannot blow up. We can only bleed to death, Taleb says. And bleeding to death, absorbing the pain of steady losses, is precisely what human beings are hardwired to avoid. So you've got a guy who's long on Russian bonds. Savory says he's making money every day. One day lightning strikes and he loses 5 times what he made. Still, on 364 out of 365 days, he was very happily making money. It's much harder to be the other guy, the guy losing money 364 days out of 365, because you start questioning yourself. Am I ever going to make it back? Am I really right? What if it takes 10 years? Will I even be sane 10 years from now? What the normal trader gets from his daily winnings is feedback, the pleasing illusion of progress. Am I ever going to make it back? At Empirica, there's no feedback. It's like you're playing the piano for 10 years and you still can't play chopsticks. And the only thing you have to keep you going is the belief that one day you will wake up and play like Rachmaninoff. Very tough to do that.